Hello, I'm Diana Higgins, and I am the author of Risk books titled Portfolio Compression, which is a technique that over a space of only 3 months reduced by $60 trillion the gross notional value of interest rate derivatives around the world. In these 5 minutes, I'm going to explain the profit and loss equation, which is a formula using compressions. And it's explained in chapter 6 of my book, where I explain how to run compression cycles. The formula says that the profit and loss before the compression is the same as the profit and loss after the compression. So let's say we have a transaction that starts delivering on the 1st of January of a given year and finishes on the 31st of December of that same year. And let's say today is the 1st of February. So we can say for sure how much profits we made between the 1st of January and yesterday. And those profits that we are certain about, we call them the realized P&L. Okay, but we said we are on the 1st of February. So we can see that based on the prices, on the price curves that we see in the future, we can estimate our profits. How much money are we going to make from the full transaction? And we called these profits that are still uncertain unrealized P&L. So if you ask a trader, which is the profit of your portfolio? Quite likely he or she will say, well, it's the sums of the profits that I already made, the realized, and the profits that I'm expecting to make in the future, which are the unrealized. Okay, let's say you say to the trader, listen, your portfolio is costing a lot of capital. So we need to eliminate some transactions so that we reduce those costs. The trader will say, yeah, of course, I want to reduce my costs. But please make sure you do not change my profits. So you can say to the trader, no worries. In compressions, we make sure that your P&L doesn't change. The idea is that your P&L before the compression is the same as your P&L after the compression. What you will have to explain to the trader is that if your realized P&L increases here, then your unrealized P&L will have to reduce here, or vice versa. The important thing is that the differences are compensated for. Also, what you will have to explain is that because we are in the real world, the match is not that perfect. So the trader will have to accept a small difference in the P&L, which we call the profit and loss tolerance. Okay, so let's put an example so that the trader can believe us. Let's say our trader bought 1,000 units of gas per month. And the gas is going to be delivered every month until the end of the year. And let's say the trader bought the gas at 20 euros per unit. So the total gas for the deal is of 12,000 units for the 12 months. Now let's say today is the 1st of February. So the prices of gas went up this month. And the trader can work out his profits. And let's imagine that the gas was on average 22 euros per unit. So the trader made 2 euros profit per unit of gas. Therefore, the realized P&L was of 2,000 euros. The trader is certain that that money is going to go into his or her account. Now, what do we do with the future? The trader can see that the market prices carry on going up, and this is, let's say, the official forward market prices. And let's say that on average, the gas in the future is expected to be at 23 euros per unit. So the trader is even happier now, because out of the 11,000 units of gas that are left to be delivered, on average is going to make 3 euros profit per unit. That means that the unrealized P&L is of 33,000 euros. Okay, let's compress. Compress means that we change the termination of the deal from the last date to an earlier date. So this transaction is not finishing anymore on the 31st of December, but it's going to finish now on the 1st of February. That means the company from which the trader bought the gas is not going to deliver more gas afterwards. So if they're not going to deliver more gas, but the trader is making money, the only fair thing to do is that the company pays the trader those 33,000 euros profit. So those 33,000 euros profit become realized P&L, because it's money that is coming in today. It is already a certain profit. And therefore, our realized P&L after the compression is on 33,000 out of all this part of the deal that was eliminated, plus the 2,000 profit that the trader made over the month of January. This gives us a total P&L of 35,000. Now, because there is no more gas to be delivered, then there are no more profits to be made. So the unrealized P&L is 0. This is what our equation says. Our P&L before the compression, 35,000, is equal to our profit and loss after the compression. This technique has been used by banks and certain corporates to reduce their cost of capital. This is because the regulations that emerged after the credit crisis, such as Dodd Frank, EMIR, the Swiss, FinFrag, MiFID, and Basel, all of them include mandatory actions that are compressions. Compressions have also been used to manage credit risk. Also, companies use compressions to reduce all the amount of data that is stored and handled in systems, and therefore reducing operational risk. There is a chapter dedicated to credit risk in energy trading. Also, the book is a step-by-step guide that is used by consultancies, regulators, banks, corporations, auditors, and people who have to make decisions, analyze, execute, audit compressions. People who have bought this book also include academics, quants, and in general those who are curious to understand what is happening in the new developments of the derivatives market.